By the way, there's something worse than a market crash. Everyone says, gee, I don't want the market to be down 5%. Well, of course. But what's worse than a market crash is just a long, slow grind downward. And this happened in 1969. The Dow Jones was 1,000. In 1982, the Dow Jones was 1,000. It was 13 years. It went nowhere. Now, there was volatility in between. It never went over 1,000 again until 82. There was volatility in between. I'm not saying you could make or lose money, but for 13 years, it went nowhere. Right. So Monday we saw a significant market crash. It's not the end of the world. There have been bigger crashes. The market has already kind of recovered about half of it today, but you're still down half over the 2-day period. So it was a big deal, noteworthy, but not the end of the world type scenario, not like 1929 or 1987. But there's something behind it. That's really what the key thing Americans should understand is that the recession is here. People have been talking about it for a long time. Okay, maybe it was slow in arriving, but the recession is here. This is what we call on Wall Street a repricing. Markets are not efficient. They don't move slowly from one level to another. They're here, and all of a sudden they go here. Now, it doesn't mean it's going to keep going, at least not yet. But for now, this is a sign. You say, what's behind it? The answer is we're in a pretty severe recession right now. That's exactly right. And that's how market corrections or recessions, for that matter, happen. You call it the snowflake that starts the avalanche, the straw that breaks the camel's back. Physicists call it a phase transition. But what it means is you go from one state to another state very quickly. You don't go smoothly and gradually, here it comes and so forth. So you need to be prepared for it, and that's what we try to help people do. So we've seen a very definite sign of that. There are a lot of technical indicators, Ben, and I don't think we have to spend a lot of time on them. Negative swap spreads and what they call the bull steepener, where short-term interest rates are dropping really quickly. Well, why are short-term interest rates dropping really quickly? Because the big money that plays in these markets, primary dealers and banks and so forth, they know that we're in a recession. Interest rates are going to come down. So they're hoarding the collateral. They're saying, buy it now at a higher yield. It's going to go down a lot more. So again, not to get too technical, but these are the signs that we see. This economic recession that we're in, for a long time we're saying it's coming, it's coming. Well, it's here now. We see it in unemployment numbers. We see it in some of the other metrics I mentioned. We see it around the world. Every month, the Biden administration publishes unemployment numbers, and then the next month when they come out with the new numbers, they revise the prior month. They've done that 13 months in a row, which means it's not complete fraud, but it's a pretty close cousin, where the job creation is not nearly what we've been led to believe. Jobs are mostly part-time, not full-time. They go into illegal immigrants, not to everyday Americans. So there's so much less there than meets the eye in terms of the employment situation. The banks are reducing their balance sheets. Collateral, which you need to support all these derivatives positions, is scarce. These are very, very serious indicators. It's coming. And by the way, this is bigger than the Fed. People talk about the Fed put, meaning, gee, if I'm in trouble, can I put my bad assets to the Fed, or will the Fed bail out the economy? The answer is there is such a thing as a Fed put, but you got to be down 20 to 30% in 2 or 3 weeks. Then the Fed will get involved. But 3% one day, not yet. But it's a very bad situation. Bad for Biden. He's the president, at least for the time being. The Harris ticket, very good for Trump. Not good for the country, but good for Trump's reelection prospects. Right. I would say, first of all, it's being felt now, Ben. So we don't. It'll get worse, but it's being felt now. Obviously, the Upper Midwest is always a leading indicator because of its industrial base, its manufacturing base, Chinese car imports. Now, Trump is going to throw tariffs on them, so that'll help. But he's got to get elected first and get sworn in. So that's something we may see in 2025, but we're not here yet. But what's interesting is that this may actually have a big impact in Silicon Valley, because a lot of the bubble. We were in a stock market bubble. I always say, people say, oh, you can't see a bubble. That's nonsense. Bubbles are the easiest thing to see. What's hard is knowing when they're going to break. When they break, they break hard. This one is off the top. It's broken. Doesn't mean we collapse tomorrow, but it's on its way down. This is going to be felt. A lot of it has to do with companies spending too much on artificial intelligence, billions and billions of dollars in artificial intelligence. And that's okay if you get the profits out of it, but they're not seeing the profits. That's the problem. It's like, okay, do the R&D, spend the money on the technology, artificial intelligence, GPT, fine. But where are the profits? And they're not there. So investors are reducing their profit expectations, stocks are going down. But again, I want to stress the point, Ben, this is a lot bigger than the stock market. People focus on the stock market, and they should, because their 401ks are probably in these stock index funds. But there's something bigger than the Fed, bigger than the stock market. It's called the economy, and the economy is sending out definite signals that we're heading into a very serious recession. By the way, there's something worse than a market crash. Everyone says, gee, I don't want the market to be down 5%. Well, of course. But what's worse than a market crash is just a long, slow grind downward. And this happened in 1969. The Dow Jones was 1,000. In 1982, the Dow Jones was 1,000. It was 13 years. It went nowhere. Now, there was volatility in between. It never went over 1,000 again until 82. There was volatility in between. I'm not saying you could make or lose money, but for 13 years, it went nowhere.
Yeah, I think as an analyst, Sean, you always have to separate what the Fed should do from what they will do, because they're always wrong. So if you can have a really acute, astute analysis on what they should do, I would say they should have cut rates maybe a year ago, or at least stop raising. Well, they did stop raising them, but maybe should have begun cutting them last fall, if not sooner, because the U.S. economy is very clearly heading into a recession. But that's my view. I can defend it, but it's not my forecast. My forecast is you have to put yourself in the other guy's shoes. You have to basically act like Jay Powell or think like Jay Powell and use that as the basis of saying, what is he going to do? So on that basis, it was very clear to me that they were not going to cut rates in June. I can promise you they're not going to cut rates in July. So that's a foregone conclusion. The July 31st FOMC announcement will be no change. So what we're really talking about in terms of forecasting is September. The Fed has a crazy schedule. They meet 8 times a year, not 12, not 4, not 2, just 8 times. Doesn't sync up with maybe a lunar calendar. I don't know, but that's what they do. So as a result, there are certain months with no meetings, and there is no meeting in August. They have this July 31st meeting. The next meeting is at the end of September. I don't have the exact date in front of me. It's around September 19th or 20th, right around there. Then there's no meeting in October, and then they have meetings in November and December. But importantly, the November meeting comes after the election. So if you want to put a political twist on this or introduce that as a factor, and I think that's a good idea, you can say, hey, the election is November 5th. The next FOMC meeting is early November, and then there's one in mid-December. At that point, the Fed's in the clear. The election's over. Whoever won, they won. Nobody can accuse the Fed of electoral interference. No meeting in August, no meeting in October, so you get a bye on those 2 months. So that it all boils down to the September meeting. The problem with the September meeting, it is exactly approximately 5 weeks, maybe even close to 6 weeks before the election. That's really close to the election. Whatever the arguments are, whatever the macroeconomic condition, absent a crisis, if there's a crisis or stock market falls 30% in the first 2 weeks of September, which you can't roll out, okay, they'll cut rates and they'll do what they have to do. But absent that kind of extreme market action, the Fed runs the risk of cutting rates just weeks before the election, which will be viewed as very favorable to Kamala Harris, the presumptive Democratic nominee, very favorable to the Democratic Party. Trump has already said, don't do it. Don't go there. Now, Trump's not the chairman of the Fed, although maybe he gets to decide who the next chairman of the Fed actually is. Well, he does if he wins. But Trump has already said, don't go there. That's tilting the playing field. That's political bias. That's political interference. Leave it alone. Call me in November. And several powerful committee chairs in the House of Representatives, which of course are controlled by the Republicans, have said the same thing. Like this, don't do it. The Fed claims to be non-political. That's nonsense. I mean, they claim it. They put on a very good show of it. They say the right things. They keep, if you ask Jay Powell a pointed question about politics, they'll say, it's not my job. It's not what we do. That's nonsense. They're highly political, always have been. I'm not saying this is the main driver or the only driver, but it's certainly one driver, one thing you have to factor in. So on the one hand, the signs of a recession, I've been calling for a long time, as have others. This is a kind of a slow motion recession. The signs are ample, whether it's, some of them are fairly technical, but yield curves are uninverting, which is interesting because they invert, meaning short-term rates are higher than long-term rates. That's the opposite of a normal yield curve. Normal yield curve, long-term rates are higher than short-term rates. The yield curve goes like this. And the idea is, hey, if I'm going to lend you money for a month or a year, I might want a certain interest rate, but if I'm going to lend you money for 10 years, I want a higher rate because there's more risk and, inflation and default, et cetera, et cetera. But sometimes yield curves invert, meaning the short-term rates they go like this, which is, it happens, but it's not normal. And so what is the yield curve telling you when it inverts? It's telling you that the smart money, the big money, expect a recession, or at best a slowdown, at worst a recession, maybe something worse than that. You can get 5.5% until recently on a 6-month Treasury bill, which is a very safe instrument, versus maybe 4.75% on a 10-year Treasury note. Well, why would you take the lower rate on the Treasury note? Well, the answer is that a year from now, that the yield to maturity on a newly issued Treasury note might be 2%. But why would that happen? What would happen if you were in a severe recession? Unemployment went up to 6 or 7%. So that 4.5% or 4.75% could look really smart a year from now if the market was at 2%. You'd have, not only would you have that higher coupon locked in for 10 years, but you'd have a huge capital gain on the instrument if you felt like selling it. Meanwhile, in the very short term, inflation is still a problem. So that's where you get these inverted yield curves, where inflation is a problem, but it looks like recession is on the way, and so it actually slopes down. Just to take that a step further, if everyone's still with me, but when you get closer to the actual recession, or when you're actually in it, you get what's called a bull steepener. What happens then? The 10-year note doesn't move a lot, but the short-term rate starts to come down a lot, and the yield curve gets uninverted, gets a normal slope at a much lower level on the short end. That's a sign that you're actually in the recession. Now the forecast the rates were going to come down has actually started to play out, and the rates actually are coming down. So that's, and there are a lot of other indicators, negative swap stress and so forth. But what it all means is that the economy is weakening, maybe in a recession already, maybe that's highly likely, and Powell should cut rates, should have cut them already. I put a lot more weight on this political factor than most others. I mean, the Fed does think long-term. I don't mean in terms of interest rate policy, that's like an overnight rate, but they don't want to be politicized. Internally, they're political, but they don't want to be on the political radar screen inside the Beltway and in the media. And so they'll likely, I think, duck this one and not try to do something that would just bring the wrath of Khan down on them. I mean, do they really want to be the center of a political debate for the last 6 weeks before the election,